In our previous examples, we saw how when we buy just one stock, the risk of in other words, the fluctuations of actual returns may be very large. In other words, we saw a high, we could be looking at a high sigma, the notation for the standard deviation. And we also saw in that example, or actually we had a couple of examples with a portfolio of two stocks, in which we saw how we can combine two risky stocks, and as a result, the portfolio standard deviation may be lower than the two stocks' individual standard deviations. And so we can actually keep going like that. We could have an even more complicated problem with three stocks and find a portfolio with such smart weights of the three stocks that would make the portfolio standard deviation even lower. And with four stocks, it can be even lower, right? And so on. Turns out that if you hold a portfolio of, let's say, 100 stocks or even more than 100 stocks, then, of course, as expected, the risk of the overall portfolio may become even smaller. But it will never go down to zero, meaning, so what does zero risk mean? Zero standard deviation of portfolio returns. It means perfect predictability of what we're going to get. In other words, it's exactly the same return every single year, no more, no less, no fluctuations. So it turns out that will never happen no matter how large of a portfolio we are trying to make. And so you can imagine this graph on the horizontal axis. If you move to the right, we are increasing the number of stocks in our portfolio. On the vertical axis, if we go up, we are increasing the amount of risk or the standard deviation of annual returns. So it turns out that as we increase the number of stocks in our portfolio, so graphically we are moving along the horizontal axis to the right, we are going to be able to lower more and more and more the overall portfolio risk. But this line, it's more like a curve. It's going to kind of flatten out, but it will never reach and cross the horizontal axis, because crossing it would mean that we reached zero along the vertical axis. So that can never happen. This is known as the so-called total risk of a portfolio. Now let's talk about how we can split total risk into two components. The first component is the so-called non-diversifiable risk. So that's kind of the level of risk, the minimal level of risk that we are approaching, but never going to be able to go below as we increase the number of stocks in our portfolio. So this is the absolute minimum amount of risk, nothing we can do about. So think about fluctuations in actual portfolio returns that will have to stay. We cannot make them go away. That's the non-diversifiable risk. So diversifiable means something we can eliminate through diversification, through adding more and more stocks to our portfolio. So this minimum amount of risk cannot go away. It's beyond our control. And the one that can go away is called diversifiable risk. So diversifiable risk is in our control. Non-diversifiable risk is beyond our control. This is how we can decompose the standard deviation, which is the total risk of a portfolio returns, into how much of it we can get rid of, the diversifiable risk, and how much of it we cannot get rid of, the non-diversifiable risk. I marked this point along the horizontal axis, 500. So this is the so-called portfolio of 500 stocks, actually largest companies' stocks in this country, also known as S&P 500, which stands for Standard & Poor's 500. So it's like, it's also what's known as the market portfolio. And it's because there are 500 different company stocks included in it, it's like representing the market, like how the economy overall is doing. Because 500 largest companies, the value of them is maybe 99% of the value, the dollar value of all companies in the economy, right, in the country. A market portfolio is actually also the same thing as the so-called large company stocks from chapter 12, which had an expected return of 12% and the standard deviation of historical returns of 19.9%. So you might remember that orange line on our graph with several jumpy lines over 1925 to 2016, 91-year time period. So market portfolio is the large company stocks, largest 500 companies in the country. So this is kind of what's used as a benchmark. That's the importance of it. The market portfolio, the S&P 500, is a real-life sort of proxy for a very well-diversified portfolio, such that everything that could be diversified away is diversified away, pretty much. I mean, it's pretty much negligible, zero. So the fluctuations in returns on this very large portfolio are those fluctuations in returns that investors have no control over. They cannot further lower those fluctuations to lower the amount of risk. Now let's talk about like what makes something beyond our control, like what is the non-diversifiable risk, as well as let's look at a couple more details on the total risk and both components of it. So the total risk is basically the standard deviation, kind of how we mathematically calculate the amount of fluctuations in some financial security or portfolio, right, based on the possible returns in different states of the economy. Now, diversifiable risk is the fluctuations that we can kind of undo. Well, not undo, but we can lower them by adding more stocks to our portfolio. There are other names which are used interchangeably, and you should know all of them. Unsystematic risk, unique risk, like unique to some company. Asset-specific risk. Asset refers to some company stock. Firm-specific risk. So what does this tell you? Like, why is it diversifiable risk? Let me give an example. Let's say a company's CEO dies, right? What do investors, how do investors behave to this news? Well, they're gonna have a lot of uncertainty about who the new company's manager will be, what will happen with the future of the company, how that will affect the investor in terms of like the dividends they will be receiving on their stock shares, right? But, okay, and so it's possible that the returns on this company's stock will may drop if the new manager kind of, is not as good as the previous one. But the loss in money on this specific company's stock is not, is unique to that company. So it's not like all other companies' stock shares that you're holding experience the same drop in returns, right? Because we are only talking about the CEO for this specific company dying. So maybe you lost money on this particular company's stock, but you see this offsetting of the loss with gains in the other stocks you have in your portfolio, right? So you can kind of undo firm-specific return fluctuations. Well, not undo, I would say more like you can cancel them out with gains from high returns in other stock from other stocks in your portfolio. On the other hand, the non-diversifiable risk, which is also known as the systematic risk or market risk, and again, you should know all three. All three are used interchangeably, equally often. This is more like fluctuations in returns caused by not some event unique to that company, but more like a countrywide event, a big event, maybe a global event, like the economy falling into recession. Think about something like that. If the country is falling into recession, then all companies are affected to some extent, some more, some less, but all companies are losing money because people are not buying their product as much as they used to. So they're all seeing like losses in revenues, losses in profits, and as a result, they're paying lower dividends to investors and the returns drop, right? So this is something you cannot diversify away because it's not like the loss on some particular company's stock in your portfolio is canceled out by gains on other stocks in your portfolio at the same time. No, at exactly the same time you see losses across the board in your portfolio. So you have an overall portfolio return drop, right? You cannot sort of get rid of it. So diversifiable risk is caused by our fluctuations in actual returns on some stock within your portfolio that are caused by events which are unique to that particular company. Non-diversifiable risk are fluctuations in returns on a particular company stock within your portfolio which are caused by economy-wide events, something that you cannot offset with gains from other stocks in your portfolio. And this is why, like going back, maybe 3-4 slides back, we had this statement that the principle of diversification tells us that spreading an investment across many assets will eliminate some of the risk, but not all of it. The type of risk it will not eliminate is the non-diversifiable risk.